Welcome to Investing Unknown One, where we're going to demystify the world of investing, especially if you're starting with little money. You might think investing is reserved for the wealthy or those with advanced degrees in finance, but that couldn't be further from the truth. The reality is that anyone can start investing, even if you don't have a lot of cash to spare. So let's break it down step by step. First things first, what is investing? At its core, investing is the act of putting your money to work with the expectation that it will grow over time. This could mean buying stocks, bonds, real estate, or even starting a business. The key idea is that you're not just saving your money, you're trying to increase its value. The earlier you start, the more time your money has to grow through the magic of compound interest. Now, let's talk about why you should invest, even if you feel like you don't have enough money. Inflation is a sneaky thief that erodes the purchasing power of your money over time. If you keep your cash in a savings account with a measly interest rate, you're essentially losing money in real terms. By investing, you have the potential to earn a return that outpaces inflation, allowing your money to grow rather than shrink. So, how do you get started? The first step is to educate yourself. Familiarize yourself with the basic types of investments. Stocks represent ownership in a company. When the company does well, so do you. Bonds are loans you give to companies or governments in exchange for interest payments. Mutual funds and exchange-traded funds, ETFs, allow you to pool your money with other investors to buy a diversified portfolio of stocks or bonds, which can reduce risk. Understanding these concepts will empower you to make informed decisions. Next, set a budget for how much you can invest. This doesn't mean you need to have thousands of dollars to start. Many platforms allow you to invest with as little as $5 or $10. The key is consistency. Even if you can only invest a small amount each month, that's a great start. Consider setting up an automatic transfer from your checking account to your investment account. This way, you're paying yourself first and making investing a habit. Once you've established your budget, it's time to choose an investment platform. Today, there are plenty of user-friendly apps and online brokerages that cater to beginners. Look for platforms that have low fees, offer educational resources, and allow for fractional shares. Fractional shares let you buy a portion of a stock, so you don't need to have the full price of a share to invest in companies you believe in. Now, let's talk about the importance of diversification. This means spreading your investments across different asset classes and sectors to reduce risk. Imagine putting all your money into one stock. If that company falters, you could lose a significant portion of your investment. Instead, consider investing in a mix of stocks, bonds, and perhaps a real estate investment trust, REIT. This way, if one investment underperforms, others might compensate for it. As you start investing, it's crucial to have a long-term mindset. The stock market can be volatile in the short term, with prices fluctuating daily. However, history shows that the market tends to rise over the long haul. Don't let short-term market movements dictate your investment decisions. Stay focused on your goals, and remember that investing is a marathon, not a sprint. Now, you might be wondering how to choose specific investments. One approach is to invest in index funds, or ETFs, that track major market indices, like the S&P 500. These funds provide instant diversification and typically have lower fees than actively managed funds. They're a great option for beginners who want to invest in the overall market without having to pick individual stocks. Another strategy is to consider dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps to reduce the impact of market volatility since you're buying more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share. It's also essential to keep learning as you go. The world of investing is constantly evolving, and staying informed will help you make better decisions. Read books, listen to podcasts, or follow reputable financial news sources. Engaging with a community of investors, whether online or in person, can also provide valuable insights and support. As you build your investment portfolio, remember to review it periodically. This doesn't mean you should react to every market dip or peak, but it's good practice to reassess your goals and adjust your investments as needed. Life changes, and so might your financial situation. Make sure your investment strategy aligns with your current goals and risk tolerance. Lastly, it's crucial to have an emergency fund before diving deep into investing. This fund should cover 3 to 6 months' worth of living expenses. Having this cushion will give you peace of mind and prevent you from having to sell investments in a downturn to cover unexpected costs. In conclusion, starting to invest with little money is not only possible, but also a smart way to grow your wealth over time. By educating yourself, setting a budget, choosing the right platforms, diversifying your investments, and maintaining a long-term perspective, you can set yourself up for financial success. Remember, the journey of investing is a learning experience. Start small, stay consistent, and watch your wealth grow. The earlier you start, the more you'll benefit from the power of compounding. And before you know it, you'll be on your way to financial freedom. So, take that first step today and start investing in your future.